Good afternoon. This is Mitch Goldberg. You're watching Be the Boss of Your Money. If it's 4:30 or a little after 4:30, we go through the market update, the news you need to know, and we talk about personal finance because we want you to be better with your money. We want you to take control of your money. I talk to people every single day, and they want my help. Some of it, though, I can't help people with. I'll give you an example momentarily. But we're going to talk about the market. Investors are spooked because all of a sudden we were in Goldilocks last week. The Fed is going to go, they sound calm, easy, couple more rate hikes, maybe one, maybe two at most. And we're going to just sit for a little while. Inflation is easing. But then we get hit over the head with this huge labor report on Friday. If you haven't heard, about 200,000 new jobs created in the economy is the number that was expected. We got 517,000. The labor market is doing way better than anyone expected. Wages are up a little, up about 4.4% year over year. They were expected to be up 4.6, but 2 basis points, 0.2% is statistically insignificant. Number of hours worked during the week went up. And it just really shouts that inflation is going to be with us longer than we expected. And the thing that the Federal Reserve is trying to do, slow the economy by impeding the workforce, is just not working. So that means the Fed might have to get even tougher. So that spooked the schmagigi out of, I just made that word up. That spooked investors. And we're going to take a look at interest rates because all of a sudden interest rates, which were trending down, are on the rise big time. So anyway, if while you're watching this, if you have any questions, please hit me up in the comments. I love hearing from you. It's the best part about doing this and doing the live stream. I can really be interactive with you, and we can actually talk, about this stuff. The other thing is, if you don't mind, give us a thumbs up, an applause, a heart reaction, a wow, whatever the reaction is, depending on which social media platform you're watching from. This is all educational. If you want to learn more about me, about our firm, check out clientfirststrategy.com. I'm going to get going with the intro now. So hang in there. We're going to have a good, quick show. And I like to do these market wraps. I like to get through quick and get to the heart of the matter. Here we go. Okay. That is over. All right. The introduction has gone away. So today is Monday, February 6th. We're just about a week into February. The first quarter is starting to go by pretty quickly. We are in a huge week for earnings. The big numbers out today is Pinterest after the close. We'll talk about that in a moment. But they were not pretty. The stock is not a pretty sight after market trading. The last 2 weeks, stocks were actually starting to go up on bad news, but stocks are back to going down on bad news. And why? Because it's all about interest rates, inflation. We were like starting to get all worked up that maybe we won't go into a soft landing. Let me explain this. The Fed wants to slow down the economy by making money more restrictive, more tighter. And what that means is, as the Fed raises interest rates, it makes it more expensive to borrow. The other thing it does is people are more likely to keep their money in short-term cash equivalents like CDs, money market savings accounts, and T-bills. A T-bill is a treasury bond with a year or less to maturity, by the way, okay? So if investors are going to take money out of the market to put their money into T-bills and CDs, these other short-term cash equivalents, that is less money for investing. That is less money to take a shot on companies. Maybe it's less financing for IPOs, for mezzanine financing, and all those other cool, nifty things we hear about how companies raise money. The hurdle for an investment to work is higher because when interest rates are zero, uh, you could find companies and securities that don't have any cash flow and that don't have any dividends and that don't have any earnings, but their future earnings are worth more because interest rates are so low. Interest rates go up, future earnings are worth less. That's how they're discounted. It's just the way the math works. And here we are. Stocks are coming down a little bit. Today, markets were down modestly. I am getting spammed like crazy in the comments. Um, you have to stop doing that, you person. I'm going to definitely block you after the show. You are definitely getting blocked. Someone from LinkedIn, which is really annoying. You're reading on. You're trying to jump on my parade. It's rude. Right. So anyway, give us a like while you're watching this. It helps spread the good word of the work we're doing to the rest of your network, and it helps the algorithm. It helps us spread the word. It helps us get in front of more people. It's really good. All right, so we had this labor report on Friday. It was really, really strong. And the previous years of 2021 and 2022, previous monthly jobs figures reports were actually revised higher. So the labor market's doing a lot better than anybody thought. And even with the layoffs, like today, Dell announced that they're laying off like 6,600 people. Those layoffs that you're seeing from big tech companies, those are not as of yet spreading to the broader economy. Just if you go on Indeed.com, like the top 25 openings for employment, almost all of them are for tech related jobs. So what happened is Dell and other companies hired like crazy to help meet demand during the pandemic. Demand has fallen off a cliff, especially for PCs. So companies are laying off employees. So companies overstock for employees. Employees went to the bigger tech companies because they're more prestigious. Maybe, employees felt safer with them, more money. These companies had more money to throw around. They didn't have to worry about raising money and surviving through the pandemic because companies like Google and Facebook and Dell and Microsoft, they did very well during the pandemic. That was a boon for their business, the work from home, stay at home trend. But that's one off. But these people in tech will find other tech jobs. So smaller companies now have a chance to find some pretty good hires. And anyway, the labor market is really strong. The unemployment rate dipped to 3.4%, which is the lowest unemployment rate since 1969. Now, there's a number for you, 1969. 1969. I'm older than that, by a little bit. Okay, so I don't really remember what the labor market was doing in 1969 because I was 2 years old, and I don't think my parents were paying attention to it either. I don't think anybody was really paying attention to it. Okay, but that's back then. So anyway, let's go on. There have been a number of buybacks. Chevron announced 2 weeks ago a $75 billion buyback. By the way, when people say there's a shortage of refining capacity and drilling in this country, just look at Chevron spending $75 billion to buy back stock. That money could go toward drilling. That money could go toward a new refinery or updating an old refinery. There's a lot they could do with 75 billion. Some people say it's politics. No, it's the company spending fortunes on buybacks. I think that oil companies maybe don't want to invest in more oil because they're worried with the trend towards sustainable energy and more EV cars expected to hit the road. Maybe they're worried that if they drill more, they're not going to have an end market for their petroleum products. Could be. I think that's what it is. And then Meta, which is Facebook. One of these days, I'm just going to stop saying that. Okay. Facebook changed its name to Meta. Meta announced a $40 billion buyback. So all the stuff you hear about Meta and Meta being hurt by Apple's privacy controls, if Meta still has $40 billion to spend on a buyback, even accounting for all the money they're spending on the metaverse, which is like turning out to be just one of the biggest flops ever. It just goes to show you how strong corporations are today. And this gives me a little more, it gives me a lot more confidence in the stock market. Granted, stocks could go down over the short term, but I'm not really looking at 2023 anymore. I'm looking at 2033. That's right. I'm looking long term. So these ups and downs, they don't scare me. I want to give you the knowledge that you need to know to get through today so that you don't make hasty decisions and bail out of everything just because the market's down. You know, intellectually, the averages always recover. Individual stocks might not always recover, but the averages always recover. So by being broadly diversified, using funds, you can use index funds, managed funds, passive funds, etc., actively managed funds. You those types of funds typically have always recovered. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. And diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Okay. And also, I'm not your mama, I'm not your papa, and I'm not your tax advisor. So when we talk about taxes here, because talking about taxes is often an important part of talking about investments and IRAs and retirement planning, you also should speak with your accountant before you make any moves that could have any implications whatsoever on your tax status and your overall tax situation. Boom. I said it. I got all my disclaimers and disclosures out of the way. That was fun. I see James is watching. James, are you still in Italy? I mean, seriously, man, you're watching me in Italy? That is awesome. The pictures you've been posting on Instagram and Facebook have been incredible. I mean, just you guys really know how to do it up. I need your itinerary. So one day when I go to Italy, I've actually been to Italy, but it's been a long time. I want to go back. And you went this time of year, and you're telling me it's like a lot less crowded now, and it's not that cold, and it's a really cool time of year to go. So I think that's very fun. I think so. Okay. So Golden Cross. This is bullish. The stock market last week entered a golden cross. Okay. Hey, thank you very much. Frank, thank you so much, buddy. It is so nice to see you, man. And you're my inspiration for live streaming. So we got to get you back on the show. Thank you very much. So we had a golden cross last week. A golden cross is when the 50-day moving average goes above the 200 moving day average. It's technical analysis. Some people call it voodoo analysis, but I do believe in technical analysis. It just tells you where money is going. It tells you, trends, charts. Okay. We've had 37, okay, count them, 37 golden crosses since 1950, according to Ryan Dietrich, an analyst that I know. And we've had that. So 37 since 1950, 78% of the time, the S&P 500 is up a year later on average of 12.7%. So golden cross. Now, when people say X amount of times when these happen, like if you have a good January, you have a good year, you have a good first week of the year, you have a good year. I enjoy these. They work just enough though to mess up your portfolio, to mess you up. They work just enough so that when everybody knows about it, they don't work. So just keep investing. Don't make changes based on the golden cross or the January this. Now the stock market is up year to date. I'm not including today's returns. The markets were off just a little bit today, but the Dow is up about a little over 2%. The S&P is up almost 8%, and the Nasdaq is up almost 15% year to date. So we were up a good amount heading into Friday's employment report. And what I'd said is that, we're already up a lot, and a lot of good news is already actually reflected. In fact, the Dow Jones Industrial Average, which is only off like 0.1% today, it's like 5% away from hitting an all-time high. And I'm looking at a lot of the industrial stocks that I follow, and a lot of them are trading pretty close to a lot of them are trading pretty close to their year high, like Granger, even United Airlines, Boeing, GE, um, a couple, Wabash National. It's not such a bad market. Caterpillar. So a lot of stocks are trading at or near highs. And I think that we have to stop focusing on this. Well, the valuation of the S&P 500 is 18 times. So we don't get a sustained rally until we're like 12 times. The S&P, the makeup of the S&P has shifted. It's like 30% plus tech stocks. You know, it's maybe 6 or 7% energy stocks. It's changed because it's more based on the growth of different sectors. So I don't think the S&P 500 necessarily needs to go down just to prove to someone, so someone could say, "You see, I told you it's going to go down to 12 times earnings before we go back up to 20 times earnings in the S&P 500." We shall see. I mean, so many people are spending so much time trying to decipher the future, and it's because we want to take control. Our money's in the market, our future's in the market. You don't want to be someone who says, "I wasted my entire adult life earnings and investing and savings for nothing." We don't want to be in that position. So I get it. So one of the things I like to talk about to help you is asset allocation. Uh, Generally speaking, asset allocation is how much you proportion your money between stocks, bonds, and cash equivalents. And if you're more aggressive, you have more in stocks, less in bonds, less in cash equivalents. If you're more conservative, you dial up the cash and bonds and you dial down the stocks. It's important to find your own allocation. And then with that, in that allocation within stocks, you pick different kinds of stocks. And within bonds, you could pick different kinds of bonds. And within cash, you actually pick different kinds of cash equivalents, from T-bills, short-term, that's short-term treasuries, to CDs, to money market savings accounts, depending on your liquidity needs. And same thing with bonds. So you might have international bonds, US treasuries, corporate bonds, preferred stocks. And then for stocks, you could go between large cap, mid cap, small cap, international, emerging markets, dividend yielders, things, stocks, categories like that. And it's important for you to build the right grouping of all these categories that's appropriate for you, because you all have a threshold for pain. You all have a point where your account goes down so much that you start shitting bricks and you hit the sell button and you just need to get out. That's panic. Almost everyone has a panic point. So the idea is to build a portfolio that's conservative enough to potentially, what happens is if the market goes down enough, your portfolio won't go down so much, and that'll keep you from uh, from panicking and selling at a really bad time, and that'll give you the ability to stay in the market, to recover and go on to new highs. That's really what a big part of the education is about this show. And when people make jerky moves, and if you think about it, in the last 30 some odd years that I've been in this industry, some of the changes are you can invest anywhere at any time. You can invest in Turkish stocks and Japanese stocks and Argentinian stocks, Israeli stocks. You could invest in coffee. You could invest in silver and platinum, gold. You could invest in literally anything because of the securitization of everything that's tradable. Exchange traded funds is your entryway to trade almost anything. So and you could trade them at any time. I mean, even though the market closes at 4, you could trade aftermarket, you could trade electronically. There's just so many ways you could trade, so many ways you could invest. But let me ask you, are investors any better at investing today than they were 30 years ago when I started? Think about this. You have all the information at your fingertips, all the annual reports, all corporate developments. It's all on the internet. It's all right in front of you. Are investors better at investing today than they were 30 years ago? I don't think so. This is why I still have a job, right? I mean, I remember when the internet was coming out and there was going to be more trading, electronic trading, all this information was going to be released into the public domain, which means people like me, the financial professionals, as an industry, we didn't have our edge. We had the information, you didn't. So we had an edge. So you had to come to your broker, to your stockbroker, to invest because we had an edge. We had the research. Now it's all out there. The research, everything, it's all out there. I don't think you have an edge. I don't think the brokers ever had an edge either, by the way. I think the edge is that we act as consultants to you, we act as moderators to your emotions, and we act as your accountability partner. And we act as almost like behavioral coaches. That's our edge. And when you can do it in a way that's unbiased, fee based accounts, for example, that to me is the real value of a financial advisor. We can bring to you ideas that you haven't even thought of. And that's when we get into like things like Roth IRAs, Roth conversions, which I really want to get into. Now, I have a radio show. I know you guys know about it because I've been talking about it, and I thought I would be streaming it. We had an issue between my network and the studio. I've been going to the studio to do the radio show. It's not recorded, it's a live show. I am actually on the radio live, and you never know what's going to come out of my mouth, which is reason enough to tune in. It's 103.9 FM, LI News Radio. You could also listen on the LI News Radio app, which works really, really well. It's very easy. You hit the triangle and you listen to the radio. It's kind of cool. But I wanted to stream them so I could have them up on YouTube and Facebook and LinkedIn. I'll start doing that tomorrow because we fixed whatever was creating the blockage. It was actually something very simple on the studio end. It wasn't on my end. Okay. The station owner actually said he would like everyone who is on his radio who streams from not in the studio, who is on the radio, not in the studio. He wants all of them to have my setup with my soundboard and my mics, and I've got a good setup. I love doing this stuff. I'm such a like when it comes to new gadgets, I am the biggest nerd. I got another mic. See this? This is another Shure mic. See, this is a Shure. You see that? I got another mic because when I have guests, I want both mics to look the same. I hate it when I'm watching like a podcast and I see 2 or 3 different kinds of mics in the podcast. I just don't like the way it looks, and I don't think it works so well either. All right, so I digress. So I've been talking about Roth IRAs today on the radio show. And I'm just sharing my open debate with you. Do I want to bring you the same exact information in the radio show and do it here and do the same exact show twice? Because what I talk about in the radio show for tax planning is huge. It's just so hugely important. And, I just want to make sure I'm bringing you value. So we talked about Roth IRAs and why it's so important to consider converting your IRA. I'm talking simple IRA, SEP IRA, traditional IRA. They are all IRAs into a Roth IRA. And the reason is simple. When you retire, you take distributions from your IRA. It's taxable income. We want to work hard now to reduce your taxes in retirement so that you, A, are taxed less or not taxed at all on Social Security, and B, to lower your contribution to your Medicare. So that's why you do it. And also you future-proof yourself from higher taxes in retirement by paying the taxes now. So when you convert money from an IRA to a Roth IRA, whatever amount of money you convert into the Roth IRA, that is a distribution from your IRA, so it's taxable income. So you pay state and federal taxes on it if you're in a state that has a state tax. And then the money goes into the Roth IRA and it grows tax-free. Not tax-deferred, tax-free, because when you take the money out, it is also tax-free. You have to leave the money in, though, for 5 years when you do a conversion, or else you get hit with penalties. Okay? And if you take the money out of, if you convert from a traditional IRA to a Roth IRA, and you decide to pay the taxes by withholding the money from your traditional IRA, that amount of money, if you're under 59 and a half, will be subject to the 10% early distribution rule. So I really like when people make their Roth conversions, when they pay the taxes for the Roth conversions from cash, from their checking or savings account, not from the actual money that's going from the IRA to the Roth IRA. In some cases, it might make sense to do it. And certainly, the more time you have, the more advantageous it should be to do a Roth IRA conversion. But even for people who are retired, it often could still make sense for them to do it. What I want to do is I want to make sure the last year I do something like this for somebody is 62, because at the age of 60, the year that you turn 63, that's the age when Medicare starts looking at your income. And if you do it at that age, it could possibly substantially raise the amount of money you have to contribute to your Medicare. Now it could change the next year because every year, every tax year could conceivably be different for you. So these are the kinds of things that I help people do with their advanced financial planning. It's not complicated, but you might not know this. Okay. Um, so a couple of other things. Could minors open up a Roth IRA? A minor could open up an IRA or a Roth IRA, but you have to have the income for it. So if a minor makes $2,000, the minor could contribute up to that $2,000 into up to $2,000 into an IRA, Roth or traditional. If a minor makes only $1,000 in a year, that's all they can contribute. They can't contribute $6,500, the full amount for 2023. Okay, $7,500 if you're over 50. So these are the things that we'll be talking about. I just want to make sure that you guys, my viewers, my pals, my social media fam, want to make sure you guys are ready for retirement. I want to make sure you guys are taking steps now to help yourself with retirement. It's not just about the hot stock. There is no investment that can do so well for you that it will negate the need for planning, for financial planning. It's just not there. A lot of people think, oh, I'll make it up on the back end. I'll hit some big winners. I'll pick a good stock. It never works. I've never seen it work personally. Maybe for some of you it works, but I haven't seen it work for anybody. And I've been dealing with investors, private retail investors like yourselves, for over 30 years. Okay. So that's about it today. I greatly appreciate you tuning in. Frank, thanks for stopping by. And I will see you guys tomorrow. Thank you.